Hello, everybody. We are going to get started. There's still some people logging in, but for those that showed up on time, we are going to keep it moving for you. So I am your host today, Carolyn, and our topic, so to make sure you're in the right place, on the right flight, going to the right city, we are doing planning with purpose today in this section, getting your company ready for transition. This is the last in our four-part series. So hopefully you have joined us on some of the others. We've learned a lot on planning with purpose and kind of some general overall thoughts on that. We talked about estates and trusts and how they play into it, valuations and determining the value of your business. And now today, Mark is going to talk about the transitioning part, kind of that final step in all of this. So that's what we're covering. Hopefully that's what you're here to learn about today. And we will keep it moving. As I always do, there is the housekeeping to be done first. So there is the toolbar, should be on the right-hand side of your screen. In there, you can get a copy of today's presentation and also Mark's bio. Also in there, you will find a question section. Feel free to pop any questions in there. We will answer them throughout the presentation and or at the end. So put anything in there and we'll get it taken care of. As soon as the webinar ends today, there will be an exit survey. If you could please complete that, let us know how the webinar was for you, if you want further meetings or conversations with Mark, and then also to topics for 2026. This afternoon, I will send everybody an email with a link to the recorded session. So if you want to go back to something, you can. And also, I will send you a copy of today's presentation if you don't grab it in the handouts. So we look forward to your feedback. So if you could please complete that exit survey and let us know if you need anything. So Mark Firm, most of you know him and have heard him present before. He's one of our regulars, but he is a CPA and partner here at the firm, has been in public accounting for over 25 years, has a broad range of industries, but he also heads up our transaction team and M&A advisory team. So that's why you're going to be hearing from him today. And before I hand it over to him, we are going to just do a quick poll. So let me launch it. And the question is, as many of you know, question is, I am. So just want to kind of see where you are at, if you're in transition or just starting, and who is just here to learn today. So that'll help Mark a little bit know who he's talking to. So as they're doing this, Mark, you ready for the holidays and everything good to go, or are you a last minute shopper?
Yeah, no, pretty much ready to go. Last minute shopper though, in some cases. But yeah, for those in the Buffalo area, looking forward to seeing the Bills win another one against Cleveland, hopefully this weekend. So
that would be nice.
Yeah,
that'd be a nice Christmas gift.
Yeah, it would be.
All right, looks like most of our people answered the poll, so we'll keep it moving. I'll just share real quickly that a lot of people are here to learn today, so no pressure, Mark. And we do have some people that are actively transitioning and some people that are 12 to 36 months out. So a little mix for you, but we'll get them educated. All right, I am going to hand it off to Mark and let you jump right in.
It's great. Well, thanks everybody for joining the call today, and it's great to have that feedback in the initial poll, because we're going to talk a little bit about, exit readiness and the related timing, like when is a great time to get ready. Well, time is actually today. You're here at this this webinar, and you're learning a little bit more about some of the things to start to think about. And we usually say that the more time that you give yourself, usually the better, just so that there's things that in getting ready for that transition, there's some important things to take care of. And then we'll also talk about exit options, different options we can talk about, and then exit planning itself, just talk through some details on what that might look like. So in terms of exit readiness, this is one of the things that we tell a lot of our clients, that it's readiness is a state of fact, not really of mind. I think that many business owners, and I'm a business owner myself, obviously of the firm, and my wife owns a small business too. And so this is something we talk about pretty regularly. But it's not, you get to a point where, hey, when I'm ready, or when I'm ready myself, the business would be ready. And that's not really necessarily the case. It's a state of fact. Like, have you gone through certain things to make your business ready for sale, ready for transition, so that you can maximize whatever your objectives are? It could be a higher valuation. It could be who you sell to, intergenerational transfers, all those things you need to get ready. That's a state of fact, and getting ready in advance. And the two major considerations are, you as a business owner ready, and that's maybe sometimes the most important, because many business owners, they spend years, sometimes decades, running and growing a business. And life after owning a business, after you put your sweat and tears into it, it can be scary. And so getting yourself ready for that personally is really important. And then, is the business ready? And in your mind, is it ready? But also trying to think who the potential a new owner is, the potential buyer or management or employees, whoever may be that next generation of business owner. What do they view the business being ready? The more ready that it is, typically the higher the valuation turns out to be, and the easier the transaction tends to be if it's truly ready. So I'm thinking about, what are some of the questions to ask yourself, or some of the considerations, and looking at, you know that you're ready when. And I'm not going to cover each and every one of these, just kind of highlight a few of those. And that the very first one, have you discussed a transition plan with your loved ones, with your families? Because that's going to impact them as well. Impact them in terms of, now you have more free time. What are we going to do? We're going to spend more time with the grandkids. Can we spend more time traveling? What are the financial implications to your family? And so having those conversations in advance, and understanding maybe what their goals are as well, is something that I think you want to factor into your decision-making process. Moving down to the fourth topic there on this page is creating a contingency plan along the way. I think that business owners, you get so wrapped up in your sort of day-to-day and working with your employees and working with your customers, sometimes you forget that you need also have a contingency plan. Even if you're not ready for sale in the near term, or ready for any kind of transition, what if something were to happen to you and you can't come to work, whether it's due to illness or an unfortunate untimely passing? We certainly want to have those contingency plans, again, so that your business is taken care of, your employees are taken care of, and then also that your family is. And so having that contingency plan is really important. And we'll talk about some of the things to think about later on here today. And then lastly, have you looked at a business valuation, and create also a personal financial plan, so that that where does your business stand today, and how does that work into all your other financial plans, estate planning things, again, which we'll dive into a little bit in the succeeding slides. So a couple of things to start to think about is considering all of your options, because some of the each option has its own sort of pros and cons. And we'll talk about those options and maybe highlight a few of the pros and cons related to those. So sometimes businesses will think, geez, well, I just need to sell the business to a third party, but don't realize that there's other options out there that could be attractive as well, either from a tax perspective, or just from a longevity and transition to that business. Thinking about, do you have a written transition plan? Is it written? Do you know what that might look like? Doesn't have to be overly formal early on, but I think the closer you get to that transition period, having some ideas written down in terms of how to execute that, I think can be hugely important to achieve those, whatever your goals are. What we talked about earlier, what is your post-business life after? What does that plan look like? And what are the types of things that you do? And one of the things, one example I give is, a business owner who has been in the corner office, right, for decades. Now there's going to be a new owner, a new CEO. Him or her is going to be sitting in your chair at some point in time. So getting through that sort of emotional transition is another important aspect. So before going through a transition, doing some type of pre-diligence, identifying some of the risks that are there resident within that business. And if we can fix some of those issues well in advance of a transition, that usually affords yourself an opportunity to enhance the value of the company. And then leadership. Are you the only person that people call to make decisions? I think over time, having that transition of management can be hugely important, can hopefully make you sleep better at night, as well as be able to take time away from the business. But most importantly, upon transition, if that leadership team is in place, that usually enhances the value of the company. So exit options. Talk about the different types of options. So there's sort of inside transactions and outside. Each of them kind of have pros and cons. We'll highlight a few of those today, but won't do a real deep dive. There's the intergenerational transfer. So these are family deals, right, to other family members, many times to children. The pros to that is it's family, right? You can help them out. It usually can be planned in advance and a very controlled process, usually. The con, probably the biggest con is it's family. You know, there's anytime you deal with these types of things, could be multiple children involved. Who's going to be the boss once mom or dad step away? There's all these different sort of intangible things that kind of need to be handled through that process. So then there could be a management buyout, right? You have managers that would be capable of taking over the business. The plus side of that is there are likely already involved in the business. The downside to something like that is they always don't have the financial wherewithal to execute a transaction, and so there's different dynamics you have to deal with there with a management buyout. So next, employee stock ownership plan, or ESOP. This is something that's becoming more and more common these days. We didn't see much of these, say, 15, 20 years ago, but they're coming back. They're becoming more common thing that business owners consider. So employee stock ownership plan, you're effectively transitioning, usually over time, the ownership of the company to a employee benefit plan, essentially, which is regulated by the Department of Labor. The benefits of an ESOP, generally, again, the employees usually take control of the business, and if you want to reward them for helping you grow that value, that can be very meaningful to a lot of business owners. The another upside or a pro to an ESOP is there are significant tax advantages. If you can execute an ESOP in the right way with the right structure, there are really significant tax benefits to understand there. Sale to existing partners. So if you have existing partners, the pro there is you already know who the owners are generally, and that transition usually tends to be smoother. The con is that usually there's a lot of debate about value and what the structured deal will look like, because usually one side of a transaction, the tax implications can be different than the other side of a transaction. So there's a lot of just sort of like issues with trying to really get the deal done. If none of those inside options, or if that's not appealing to business owners, there are outside options. A sale to a third party or a recapitalization. This is one I want to talk a little bit about, because a lot of business owners don't think about this option, in that you can borrow money from the bank, take a dividend, take some chips off the table, maintain ownership of the business, hire a key manager to run the business, and you get to spend a lot more time with the family. And then maybe down the road, consider the other options, whether it be an inside transaction or a sale to a third party. So that recapitalization and making it a lifestyle company is an important option to consider, depending on again, your goals and where you sit in your in terms of age and other life cycle issues. Additional public offerings, these aren't overly common. A lot of the clients that we work with, small and medium-sized businesses, IPOs just aren't that common, so we generally don't run across those too often. And then lastly, there are an orderly liquidation. There are some businesses, particularly much smaller ones, that are very niche-y and maybe really reliant on the business owner. Sometimes it's better the owner to consider just to liquidate, sell their assets if they happen to have equipment or otherwise, liquidate any working capital that they have, like receivables, and that might sometimes be financially more viable than, say, trying to sell the business or trying to pass it to children or sell it to management. So exit planning, when should I start? Well, a good time to start is today. How many times we tell clients, usually that timetable, like to have at least 2 years. There's many things that we can do or that a company can do to get themselves ready for sale. The example I give is when you go to sell your house. You don't usually stick a for sale sign on the front lawn and start letting people in that afternoon, right? Usually clean the house, fix the foundation, make sure certain walls are painted, make it look really nice and newer and presentable. And that's the same concept for business. And it just takes time. Some of those things do take time, more than just a month or two. We usually like to say 2 years. Ideally, actually 5 years would be more ideal. There's some tax planning strategies that take time to implement and sort of ferment, if you will, to realize those tax benefits. Many times those take, sometimes up to 5 years to do that. And what do I think about? Well, that's what we're going to talk about sort of on the succeeding slide. So this is a great way to think about exit planning and all the different factors. And this is something that comes from a book written by Christopher Snyder, who wrote a book called Walking to Destiny. He had experiences in working with his family's business, and that experience sort of caused him to write a book. And he actually founded the Exit Planning Institute, which is really trying to educate business owners as well as provide certifications for certain professionals to help their clients with exit planning. And so, but this is a nice way to sort of just think about it and all the different types of things, the personal issues, financial, tax, how to create additional value, and some of the business issues and legal issues to deal with. I'm not going to talk about the business issues and legal side. Those are some things that I'm thinking about, bringing your attorney into the conversation. On the business operational side, it can be a varied number of different things that you have to consider there. But I want to focus more on personal issues, the other 4 on the right-hand side here about some of the things. And we'll do a little bit of a deeper dive on that today. So talking about personal issues, what are the things to start thinking about? And some of these we actually, as Carolyn mentioned, this is, I think, last in a series of planning, exit planning. And we did a general overview in our first series, first of the series. And then we did a deeper dive on valuations as well as estate and gift planning. Please, I think those are posted on YouTube.
Yeah.
You can see those, right, Carolyn?
Yes.
So if you want a refresher, if you didn't catch those are great presentations to watch about, and goes a little bit of a deeper dive. But thinking about these different elements and giving yourself, again, that 2 to 5 year time horizon can be crucial to execute the plan effectively and meet your objectives. So first is update your estate plan. What does your estate plan look like? Usually a business is that it doesn't necessarily have a known value, right? You have to get a valuation to understand, where do I sit today? And I would say that most business owners tend to overvalue their business. Not always, but they tend to. And so getting that sort of realistic view of evaluation is important. And how does that impact your estate plan? As I know was mentioned in that webinar that we did a few weeks ago, not only to consider federal estate planning, but here in New York State, as an example, there is a cliff estate value of 7.2 million. So once you get over, your state gets over 7.2 million, the entire state is subject to New York State estate tax. And so understanding where you sit on that element, that level, can help you maybe deploy gift and trust strategies and other strategies to help limit that tax. So again, please feel free to watch that other webinar on YouTube to get a little bit more deeper dive on that. So we talked about valuation strategies. Along the way, life insurance. So we mentioned before about the contingency plan. What happens if something were to happen to you untimely? You want to make sure that the company's taken care of, and you want to make sure that the family is taken care of. And so that life insurance is a safety net, both for the company as well as your family, so that it can, if something were to happen, it can take various measures to make sure that the health and value of that business continues without you being available to run it. And then investment advisory is taking a look at your investment portfolio and how does that interact with the value of your company, any other assets you have, and then going back to, again, to your estate plan to determine, are there things that I should be doing to limit that tax? So on the financial issues side, this is really intended to talk about the financial reporting of the company and some of the things that you can start doing in advance. And many times we help our clients sort of look at their what's called an internal QOE, or quality of earnings. And it's something that we help them update periodically. What does that mean? What that means is, I know that you have probably financial statement, a balance sheet, income statement, and likely tax returns. They're prepared maybe internally. You might have CPAs that come in and help you prepare those as well. Sometimes some companies have an audit of their financial statements or a review, but if not, you probably likely have internal financial statements as well. Well, the quality of earnings analysis, what that does is it tries to understand, are there any non-recurring income or expenses that aren't really the sort of ongoing cash flow of the business, or are there personal expenses being run through the business that a potential buyer might view as, again, non-recurring, such things as club memberships, personal cars and vehicles that are being run through the business. And there's also payroll. You may hire family members that aren't working in that business. And so those are all types of expenses that generally won't recur after a buyer acquires the company. And so we take a look at what are the true earnings, if you will, the ongoing earnings, or what's referred to as pro forma earnings of that business. And usually that ends up being higher than what you would see on the face of the financial statements. And so having that understanding and how that impacts value is really important, so that you can sort of navigate where you want to end up being ultimately if you exit the business down the road. Financial statement readiness, make sure that the books are as clean as possible. If there's issues there, how can we fix those? How quickly do you get your financial statements? So you usually tell a business owner, if you don't get your financial statements for the prior month within 10 business days, there's probably some improvements that can be made there. And the reason is that when you get into particularly a sale to a third party, you want to make sure you can produce those financial statements so there's confidence that those financial statements are as clean as you can get them. And usually the faster you can provide them, it's an indication that the financial records are in good order. Similarly with internal controls and procedures. This is something that, for many people, it seems kind of boring, right? and at times it can be, but making sure that your systems and your procedures are as efficient, as effective as they can be. And I know that can't always be accomplished with a small business with limited resources, but to take a look at those and see what risks and exposures and business process improvement opportunities you have. This will likely only enhance value if you go through that process and make those improvements. And a shift in mindset from tax planning to EBITDA enhancement. What is it? EBITDA, again, earnings before interest, taxes, depreciation, and amortization. That's what's referred to as EBITDA. That's a common measure of cash flow that's used to value a business. And what do I mean by this? Many times a private company, they want to limit reported profits so as to reduce taxes and take certain measures. And it could be, again, all sorts of different things that you can deploy to minimize your tax. But in getting ready for a potential transaction where you want to enhance value, you want earnings to be higher. So it's understanding what that impact might be on your tax obligations while you're on your way to that transition point. And then looking at your net working capital. One of the things that surprises a lot of our clients when they get into a potential sale, especially to a third party, is they have to do, as part of the value of the business, they have to deliver a certain level of net working capital, receivables, less your payables, and any other working capital that you may have. And assessing how healthy is that working capital? And is it right around where we think it should be? Is it in excess of what you need to deliver? Or do you have a deficiency? And along the way, how can you make corrections to make sure that you're delivering the right amount of working capital so there isn't any rash business decisions, action taken prior to the deal that would cause any significant issues for you. So tax issues, there are plenty to talk about in this area. I just wanted to highlight just a couple things for people to consider. If there's that very first one, state and local tax assessment, and I'll explain to that in a moment here, but if there's any topic in this tax planning area that you can sort of circle, star, and put an exclamation point next to. Why do I say this? Is because most commonly when a company is ready for sale, the most frequent issues we find that will either crater a deal and or will reduce a significant reduction in value is around the state and local taxes. And it seems kind of odd, right? It's more of a compliance thing. But what happens is many clients that may not necessarily be in compliance with all the state and local tax rules across the country. There's probably hundreds of state and local tax compliance laws, as well as taxes that you have to assess, depending on how you do business. There's sales tax and there's income tax all across the country. And so going through an assessment to determine where are my risks, am I filing all the right in the right jurisdictions, and am I paying tax in all the right jurisdictions? That can be hugely beneficial to go through that process so that when a buyer comes in to do their diligence, if you've done this assessment already and you're in compliance, then that'll greatly enhance not only the value of the business, but in terms of closing the transaction, it'll speed up that process greatly. Tax structure assessment. Taking a look at what's the form of my business. Example is if you are a C Corp, a C corporation, that there's many things that you should be thinking about if you were to say do an asset deal out of C Corp. Many times there's a double layer of tax that you'd like to try to avoid. So how can we avoid that? What are the different things that we can do, whether it's converting from a C Corp to LLC or C Corp to an S Corp? That, remember, we talked about the timing, a number of years that it will take in order to plan for an exit. For a C Corp conversion, it takes up to 5 years in order to get rid of that double layer of tax before you can execute a transaction and avoid that double layer of tax. So again, it's planning ahead and understanding what that structure looks like. And then just one last area that I want to cover in tax here is transaction projections. And this becomes more and more relevant as you get closer to a potential sale or some type of exit event. It's taking a look at what are the tax implications and what's the ending cash flow to the business owner. And it's everything from, hey, I got debt out to a bank that I still got to pay out. There's taxes that I have to pay. Many times a buyer will say, hey, set aside some money into an escrow to cover any issues that you hadn't disclosed to us. It's referred to as a reps and warranties identification. You usually have to hold that in separate escrow for 12 to 18 months. So you're not getting all that cash up front at close. And so understanding what that looks like and its tax implications, I think can be hugely beneficial to plan that process. And then just lastly, talk about value creation. So we talked about planning and readiness and what are the things that we could be doing. And this can be really important, again, if you give yourself more time to understand what are the drivers of valuation. And take a look, and as I mentioned, we did a really deep dive on this in a previous webcast. Please go to YouTube to take a look at that. But having that advanced knowledge is power, right? And to understand what are the different levers that we can pull to make our business more valuable. But really the starting point is sort of having that foundational valuation that you can understand, okay, and many times, as I think I mentioned before, business owners tend to overstate the value of the business for many different reasons. and understanding what those drivers are, cash flow, the strength of your balance sheet, the strength of your management team, any other risks that we see in that business, and how can you start solving some of those issues, if you will, to make the business more valuable. In the end, if you've made all those changes and made your company more valuable and you decide not to sell, well, what you're left with is a more valuable company that's likely cash flowing better. So what a better result. But then if you do decide to sell the business or to enter into some kind of other exit strategy, a higher value usually is more beneficial. And taking a look at what areas in terms of business process improvement, more effective operations and higher margins. Is our pricing strategy with our customers where it should be? Are there cost saving measures that we can put in place? We actually work with a really great partner here in Buffalo, an organization called Meliora, and they are real experts in this area. And they help a lot of our clients when needed to kind of go through this business process improvement. And if you think about it, I'll just give you a quick example. Let's say a company's EBITDA, we talked about EBITDA a short time ago. If it's $1 million, right? And let's just say the multiple is 5 times. If you're able to, so that would tell you the value, enterprise value is 5 million. Well, what if you could increase that the EBITDA to 1.2 million because of business process improvements, reduction in sales? Well, now all of a sudden your company is worth 5 times 1.2 million or 6 million. So you've just increased that value substantially. And along the way, made yourself more profitable, and cash flowing has also increased. So it's looking at that those business process improvement opportunities can be very helpful. And then I'm going to just quickly skip down to risk identification. One great example that we talked about, sales and use tax right before, making sure that you're in compliance with sales and use tax. That's just one example. But customer concentration. If you have a significant customer concentration, what are things that we can do to expand our customer base so that usually the more, if you have just say one customer, a buyer is going to be really hesitant to pay you up front for the purchase price for your company if you're doing business with only one customer. That's high risk, and usually a higher risk means lower valuation. So, but if you can take the time, again, that 5-year time period, let's expand our customer base so we don't have such a high concentration. That can usually result in most cases, a higher valuation. Buyer market research is understanding, what does the buyer market look like? Is it active? Who are the types of buyers? A lot of private equity firms getting into the game, or mostly strategic buyers? And what are the multiples that we're seeing in the market for your industry, so you can understand is now the right time to start planning an exit. And then lastly, benchmarking. This kind of goes along with the market research, as well as the business process improvement. So benchmarking yourself against similar companies. So understanding, what are gross margins? What are we in line? Are we ahead or behind the industry? What does our profitability, pre-tax profits look like? Our cash flow, and as well as the health of our balance sheet. Benchmarking it, say, okay, now if I know that I'm behind in certain metrics, again, what are those levers that I can pull along the way to improve those metrics to make our company look more profitable against our peers? So that's, I think, all I had for today. I wanted to thank everybody again for joining, and I will turn it back over to Carolyn to some closing remarks and maybe a polling question as well.
Yeah. Mark, can you give us an example of maybe a recent transaction that you've done that went really smoothly and kind of what contributed to that? And then maybe one that totally went off the rails and maybe kind of a point of like why that happened, to kind of give our audience a beware of something as simple as X, and again, kind of what that ideal situation looks like.
Yeah, so on the first one, so those are great questions, and we get that, those are common questions. So, on the first, where we saw a transaction go really well. So it was a family-owned business, and they knew, upwards of 6 or 7 years ago that they needed to have some type of exit strategy. And so we started talking to them about that pretty early on. And so we kind of outlined with our client the different steps that we talked about, risks and where there were risks, and there were some sort of financial reporting matters that needed to improve on, and just some other key elements. And they took that time. And they also said, hey, we want to obviously become more profitable, and that'll make our business. Well, what are some of the things we can think about? And they had they hadn't really gone through a vendor review to see, are we paying the right prices for our raw materials? And so they went through that, went through some bidding process with some of the vendors, decreased their costs, and obviously increased their profits, again, which made their company more valuable. And that took them, good 2 to 3 years. And so when we got to going to market and getting the company ready, that diligence period went a lot smoother, and we didn't have any surprises along the way, and they achieved their valuation expectation. So that was an example, again, where they did a lot of planning up front. One recent example of something that didn't go so great, and it's a company that really didn't plan that well in advance, but they had a couple of legal issues that were undisclosed to the buyer. And those legal issues came up in diligence. And actually the buyer decided to walk away. And so what the company didn't necessarily realize is that you have to sort of either disclose those in advance or solve them in advance of a transaction, so that it wouldn't cause any significant concern from the buyer's perspective. So that deal actually never happened, and they're still trying to retrench and try to determine what their next steps are.
Yeah, and it's sometimes the simple things or seemingly simple things to getting ducks in rows and really identifying what those triggers might be to make something go sideways very quickly.
Yeah, a lot of times too, talk to your external CPA, right? A couple of things that we usually measure, say the readiness from a financial reporting perspective, is how many, if you have a CPA that does an audit of your company, how many audit adjustments do they have?
Mm-hmm.
Typically, the more audit adjustments there are, it tells us that the books and records sort of on an ongoing basis need some checkup, and hence the need for an audit. And so usually the less audit adjustments there are, the better well kept your financial reporting is. And it's the same with, how long does it take you to get your monthly financial statements from your controller or CFO? If it takes you 30 days, it's probably telling you something that why is it taking so long? In today's day and age and sort of technology, I think I mentioned before, 10 days. If you don't get it within 10 business days, you likely have some improvement that you could probably be making there.
Right. And even again, what do those receivables and payables look like, and how stretched are they or not stretched? I know I worked on a project one, and state and local tax almost blew up the deal. The company wasn't collecting and remitting sales tax properly, and the deal ended up going through, but the company that was selling had a lot of cleanup. It almost killed the deal, and there was a lot of money that they weren't aware they needed to clean up. So that's a huge impact on the deal. Could have blown it up, but money they also weren't anticipating or knew that they owed. So
yeah, we had a transaction where the total exposure on that sales tax liability was about $5 million.
Okay.
So the buyer said, we can either reduce the purchase price by $5 million, or you can put $5 million in escrow. And because the sort of look back period on some of these tax audits that can occur across the US are quite long, is that you can keep an escrow in place for 3 or 4 years. None of that was appealing to our client. And so he said, hey, we're going to retrench and try to fix these sales tax problems. We'll come talk to you in 2 or 3 years.
Right.
So that transaction was paused for a bit.
yeah, I mean, if you think about the resale certificates, and
Yeah.
if you were thinking things weren't taxable and maybe they were, or you were paying tax on things that you shouldn't have, then there's a lot there always in the salt group, and making sure that things are nice and clean. And what is the reaction of employees once this is announced, and how's that going to impact the new owner?
Yep.
So a lot out there. If you do have any questions, feel free to put them in the question section. We'll get those answered for you, but we still have time with Mark today. We're wrapping up a little bit early, which is nice for some of you. I am going to, as you're putting those questions in, I will do our second poll. And again, based on what you learned today, how are you feeling? Hopefully they're not confused, or as my option here is, I'm not good. But hopefully you were able to give them the education they were looking for today in joining us. And again, if anybody has questions, feel free to get those answered by Mark while you got his attention today. As I said, I will send out a copy of the presentation and recorded session to you this afternoon. So if you want to go back and re-listen to anything, you can do that. So it looks like most people are good. I'll just close out the poll and kind of just share kind of real quick with you, Mark. So it looks like a lot of people are good. They're on the right track. Other people are good and just have some work to do. So.
Well, that's good. I think it's, if you're in that sort of good, but have work to do and you kind of know what your plan is, I think that's probably the most important. I think that, we're not striving for perfection. There'll never be perfection. It's always going to be issues, but the more that you can solve up front, and if it's unsolvable, before talking to a prospective buyer, the unsolvable pieces, you can at least disclose up front and understand how you're trying to manage that risk. And the fact that you've identified it and are trying to manage that risk is better than either not disclosing it or have not discovered it, which would probably be the worst case, not discovering it, not doing anything about it.
Right.
So.
Well, again, you can prepare and over prepare, and then your business will never get up for sale. But
Yeah.
Again, you need to do as much as you can ahead of time.
And the last, I know you're going to talk about the OBB, the one beautiful big bill here that we're going to have a webinar, and that's going to be important. It may cover some many issues there, but there are changes as a result, even in the transaction world. So I'll leave that to those experts to kind of talk about that. But one of the things that I will mention that we did see a question that came up here that I just noticed, Carolyn, was what's referred to as qualified small business stock, or QSBS. Like, how does that interplay? And that's a special, and that's there's some changes there. So please come to the December 18th event where we talk about some of those things. But the qualified small business stock is what's referred to as Section 1202 of the IRS code. And that is a method by which, depending on the type of stock, as well as how that stock was formed, as well as who has owned it. It has to be original issuance stock, and there's a lot of other different criteria they have to reach in order to get significant tax benefits from this qualified small business stock. But for many of our clients, that's a great question. It's something to put on your radar screen. And again, please tune in on December 18th for that.
Yeah, Kevin has a whole section on that. So
yeah.
We'll be going over that and a couple of the other clarifications and updates since that bill went out July 1st. So that is Thursday this week at the 18th at our usual time, noon. And just to finish up here is Mark's contact information if you want to reach out to him directly. Also to go to the QR code for our past webinar recordings and topics. So if you missed any of the first 3 in this series, feel free to see those. Also too, you'll see the recorded session on OBB back in July. If you want to go back to it, listen to the first one and then join us on Thursday. And always follow us on LinkedIn for updates and upcoming webinars. So thank you everybody for joining us today. And thank you, Mark, for being our expert.
Great. Thanks everybody. Enjoy the day.